Welcome to MBA 620, Financial Decision Making. My name is Dr. Richard Works, and I will be your instructor for this course. In this lesson, we will be discussing Project 4, Finance for Managers. Step 1 is to analyze financing and investing activities. The time value of money, consumed today or tomorrow. The time value of money is based on the belief that people prefer to consume goods today rather than wait to consume the same goods tomorrow. An apple we can have today is more valuable to us than an apple we can have in 1 year. Money has the same time value because buying an apple today is more important than buying an apple in 1 year. However, financial managers have to determine today's value of a future cash flow or a series of cash flows, mostly in financing or investment decisions. Timelines help us to correctly identify the size and timing of cash flows, which is a critical task in solving time value problems. This timeline shows the cash flows generated over 5 years by a $10,000 investment in a situation where the relevant interest rate is 5%. As we can see here, the first year cash flow is $5,000, the second year is $4,000, the third year is $3,000, the fourth year is $2,000, and the fifth year is $1,000. Compounding is when we start at the present value at year 0 and go forward to find the future value. On the other hand, discounting is when we start at the future value and work backwards to determine a present value. The general equation to find future value is future value equals present value times 1 plus the interest rate to the power of the number of periods, which is often in years. Compounding interest. I will pause for a moment to let you review this graphic because this will explain clearly the compounding interest. Future value of $1 for different periods and interest rates. The higher the interest rate, the faster the value of an investment will grow, and the larger the amount of money that will accumulate over time. Because of compounding, the growth over time is not linear, but exponential. The dollar increase in the future value is greater each subsequent period. The more frequently interest is compounded, the larger the future value will be at the end of a given time period. For example, if compounding occurs m amount of times within a period, the future value equation becomes future value equals present value times 1 plus interest rate divided by m to the power of m times the period. This graph shows future values after 10 years with different compounding frequencies. The daily amount will be $271.79. The monthly amount will be $270.70. The quarterly amount is $268.51. And the yearly amount is $259.37. In this course, we will use Microsoft Excel to determine these values instead of doing the calculations by hand. Continuous compounding is when compounding occurs on a continuous basis, and therefore the future value equation implements the E value in the mathematics, which is 2.71828. And on the screen now is the equation for that. Comparing future value and present value calculations. We see here that $100 in year 0 at a 10% interest rate after 1 year will be $110. However, if we said we needed $110 1 year from now with a 10% interest rate, then we can say today I would need to invest $100. Present value and discounting. The general equation to find present value is present value equals the future value divided by 1 plus the interest rate to the power of the period. 1 plus the interest rate to the power of the period is called the present value factor or discount factor. In discounting, the interest rate is called the discount rate. Time and the discount rate affect present value. The greater the amount of time before the cash flow is to occur, the smaller the present value of the cash flow. The higher the discount rate, the smaller the present value of the future cash flow. This graph will show you the present value of $1 for different periods and discount rates. I will pause a moment to let you review this. This is another graphic that will show future value and present value compared using compounding. Please take a moment to also review this one. As with the future value, we will also be using Microsoft Excel to calculate the present value. So you will not have to do this manually, as we will be using the software to make our calculations. As with the future value and the present value, we will also be using Microsoft Excel to perform the calculations for the net present value. Finding the interest rate. Many situations require using a time value of money calculation to determine a rate of change or growth rate. An investor or analyst may want to know the growth rate in sales, the rate of return on an investment, or the effective interest rate on a loan. We can manipulate the formula for future value by using algebra to solve for the interest rate. However, as with the other calculations, we will also be using Microsoft Excel to perform this task instead of having to do the mathematics manually. In a similar fashion, we can also use algebra to manipulate the future value formula to find the number of periods. Types of annuities. Ordinary annuity is when cash flows occur at the end of a period, for example, a mortgage payment or an interest payment to a bondholder. Annuity due is when cash flows occur at the beginning of a period, for example, a lease. Present value of an annuity. What is the amount needed to produce the annuity? What is the current fair value or market price of the annuity? And what is the amount of the loan that can be repaid with the annuity? Here on the screen, you see the formula for this calculation. This graphic shows a future value of multiple cash flows. I will pause a moment to let you review this material. In similar fashion, this graphic shows a present value of multiple cash flows. And I will also pause here to let you review this. In general, the future value and the present value work in the same ways except in reverse. An annuity is a series of equally spaced and level cash flows extending over a finite number of periods. A perpetuity is a series of equally spaced and level cash flows that continue forever. The formula shown here is how to take the annual payment of an annuity. However, as with the other calculations, we will not be doing this by hand. We will be using Microsoft Excel to perform our calculations. To find the interest rate of an annuity, you cannot simply solve for I, and analytically, we will also be using the Microsoft Excel function for rate. Using the Microsoft Excel functions makes the job of a financial manager and an accounting professional much easier than it would be if we had to do our calculations by hand. So please become familiar with these Microsoft Excel functions that we are covering today. Perpetuities are a stream of equal cash flows that go on forever. Preferred stock and some bonds are perpetuities. And here is the formula for that. But as we mentioned, this is for informational purposes, as we will be doing our calculations using Microsoft Excel. The most common way to quote interest rates is in the terms of annual percentage rate, APR. It does not incorporate the effects of compounding. The most appropriate way to quote interest rates is in terms of effective annual rate, EAR. It does incorporate the effects of compounding. To calculate the annual percentage rate, it is the periodic rate multiplied by the number of periods in the year. This does not account for the number of compounding periods or adjust the annualized interest rate for the time value of money. This is not a precise measure of the rates involved in borrowing and investing. The effective annual interest rate accounts for the number of compounding periods and adjusts the annualized interest rate for the time value of money. This is a more accurate measure of the rates involved in lending and investing. The time value of money is the idea that money available at the present time is worth more than the same amount in the future due to its potential earning capacity. This core principle of finance holds that, provided money can earn interest, Any amount of money is worth more the sooner it is received. The time value of money is also referred to as present discount value. Present value is the value of money today. Future value is the value of money in the future. Interest rate or discount rate is indicated by the letters I or R, and the number of periods is indicated by the letter N. Calculating the present value is a matter of plugging in the future value, the interest rate, and the number of periods into an equation. Calculating the present value of a single amount is a matter of combining all of the different parts that we have already discussed. But first, you must determine whether the type of interest is simple or compound interest. 3 variables are needed to solve these equations: the future value, which is the known value of the money at the declared point in the future; the interest rate or discount rate, which is the percentage of interest paid in each period; and the number of periods, which is represented by the letters N or T. For example, assume the sum of $10,000 is invested for 1 year at a 10% interest rate. The future value of that money is $11,000. Example 2. The formula can also be rearranged to find the value of the future sum in present day dollars. For example, the value of $5,000 1 year from today, compounded at 7% interest, is $4,673. Net present value is calculating the investment's net value added to the cash flow of the firm. If net present value is greater than 0, then we do the investment. First, we identify the amount and timing of the cash flows required over the life of the investment. Second, we establish an appropriate interest rate to be used for evaluating the investment, typically called the required rate of return. This rate is also called the discount rate or hurdle rate. Third, we calculate and evaluate the net present value of the investment. And then, if the net present value is greater than 0, we accept the project. The net present value formula for the initial investment is shown on the screen. I will pause here for you to review this. The net present value formula for projects generating revenue at varying rates over time is also shown on the screen. I will pause here so you can review this one as well. Example 1 for even cash inflows. Calculate the net present value of a project which requires an initial investment of $243,000, and it is expected to generate a cash inflow of $50,000 per month for 12 months. Assume that the salvage value of the project is 0. The target required rate of return is 12% per year. Please review the screen to see how this will be worked out manually by hand. The internal rate of return, or economic rate of return, is a rate of return used in capital budgeting to measure and compare the profitability of investments. In the context of savings and loans, the internal rate of return is also called the effective interest rate. The term internal refers to the fact that its calculation does not incorporate environmental factors, for example, the interest rate or inflation. The payback period refers to the amount of time it takes to recover the cost of an investment. Simply put, the payback period is the length of time an investment reaches a break-even point. Determine the corporate valuation. Dividends are distributions of earnings by a corporation to its stockholders. Usually the corporation pays dividends in cash, but it may distribute additional shares of the corporation's own capital stock as dividends. Occasionally, a company pays dividends in merchandise or other assets. Since dividends are the means by which the owners of a corporation share in its earnings, accountants charge them against retained earnings. Dividends are always based on shares outstanding. Common stock is a form of ownership in equity that still earns rights of ownership for its shareholders. Preferred stock usually carries no voting rights, but may carry a dividend and have priority over common stock upon liquidation, and may also have other benefits. Options give the owner the right to buy or sell, but not the obligation to buy or sell an underlying asset or instrument. The key specifications and features of options include the following. An option that conveys the right to buy something at a specific price is called a call. An option that conveys the right to sell something at a specific price is called a put. This is how I remember the difference between a call and a put. If I have something that I want to sell, what am I going to do? I'm going to put it up for sale. If If I have a house that I want to sell, I'm going to put my house up for sale. On the other hand, if you have a house that you want to sell and I want to buy it, then I'm going to call you and I want to buy that house. If you have something else that I want to buy, I want to call you so I can buy that. So a call gives you the right to buy at a specific price. A put gives you the right to sell at a specific price. Risk is pervasive in the economy and is an essential component in determining an asset's investment return. Risk premiums compensate holders for risk inherent to an investment and are incorporated in the rate of return quoted for an investment. A return, also known as a financial return, is the money made or lost on an investment. If we make a profit on our investment or venture, we have a positive return. If we lose money on our investment or venture, we have a negative return. The capital asset pricing model is one method of determining the appropriate discount rate in business valuations. This method derives the discount rate by adding the risk premium to the risk-free rate. In this instance, however, the risk premium is derived by multiplying the equity risk premium times beta, which is a measure of the stock price volatility. Beta is published by various sources for particular industries and companies. Beta is also associated with systematic risk of an investment. The CAPM formula is shown on the screen. R is the expected rate of return of the investment. RF is the risk-free rate. Next we have the beta. Then we have the expected return on the market minus the risk-free rate. The risk-free rate, also called the risk-free interest rate, is the interest rate on a debt instrument that has zero risk, specifically default and reinvestment risk. The formula for the real risk-free rate of return is 1 plus the nominal risk-free rate divided by 1 plus the inflation rate. The dividend discount model values a firm at the discounted sum of all of its future dividends and does not factor in income or assets. This model is a way of determining the value of a company based on the theory that a stock is worth the discounted sum of all of its future dividend payments. Step 3 in this project is to evaluate the annuities. An annuity is a type of instrument in which regular payments are made over the course of multiple periods. They have several principal characteristics. Annuities have payments of a fixed size paid at regular intervals. There are 3 types of annuities: annuities due, ordinary annuities, and perpetuities. Annuities help both the creditor and debitor maintain predictable cash flows and spread payments of the investment out over time. The present value of an annuity can be found by calculating the present value of each individual payment, then adding them together. However, using the Microsoft Excel function PMT is highly recommended. Step 4 in this project is to discuss the risk and returns. A return, also known as a financial return, is the money made or lost on an investment. A return can be expressed nominally as the change in dollar value of an investment over time, or as a percentage derived from the ratio of profit to investment. In the discussion forum, describe the various types of returns and use citations for support. The term financial risk is broad, but it can be broken into categories to understand it better. Asset-backed risk affects investments in asset-backed securities, such as home loans. In order to finance home sales, banks issue bonds that serve as a debt obligation to its buyer. The buyer of the debt is essentially receiving the interest from the bank that the home buyer is paying to it. Prepayment risk is the risk that the buyer goes ahead and pays off the mortgage. Therefore, the buyer of a bond loses the right to the buyer's interest payments over time. Interest rate risk refers to an asset whose terms can change over time, such as a variable rate mortgage payment. Credit risk or default risk is a risk that the one borrowing the money will default or stop making payments. Liquidity risk is the risk that an asset or security cannot be converted into cash in a timely manner. Some investments, such as stocks, can be sold immediately at the current market rate, and others, such as houses, are subject to a much higher degree of liquidity risk. Market risk is a term associated with losing value in an investment due to a decline in the market. Operational risk is another type of risk that deals with operations of a particular business. Foreign investment risk involves the risk associated with investments in foreign markets. Model risk involves the chances that past models, which have been used to diversify away risk, but will not accurately predict future models. Step 5 in this project is to write your executive summary. An executive summary is a brief document typically directed at top-level managers, who sometimes make decisions based on reading the summary alone. As a result, the summary must be concise but comprehensive and include the problem, the purpose, the method of analyzing the problem, the results of the analysis, and the recommendations. And you can also include facts and figures to support your claims and results. That will be all for this project. And please remember that the formulas were informational purposes only. In this project, we will be using the Microsoft Excel functions. Thank you.